Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending April 2nd, 2021. I'm Preston Brent. Thanks for tuning in. This week's theme is no worries, it's party time. And certainly if you look at price action, it clearly looks like that. Let's take a look at what happened this holiday shortened week. Let me just get some data up on the screen for you here, and we'll just kind of see where things are going. So if we look at the index performance for the week, you can see everything was in the green, from the Dow to the Russell. NASDAQ playing a little bit of catch up. Year to date, the Russell is still leading the way, 14.13%. Dow is up in the second place, 8.32%. Pretty strong start to 2021. And if we look at the week's best sector performers, technology obviously had a rebound from some of the sell-off. It was up 3.15%. The worst sector is energy, 0.38% to the downside. And if we look at the annual sector performance, energy still leading the way at a little over 34%. Staples in the green, also at 1.33. So all the sectors are in the green year to date so far. If we look at valuations and volatility, you can see in the upper right corner of your screen, the forward PE ratio is still very rich at 23.12. Okay, still a very rich PE ratio. Dividend yield came in just a little bit. It's at 1.45%, which would make sense as the S&P goes higher. And the 10-year Treasury finished out the week up 1.71%. So that put a spread between the 10-year Treasury and the dividend yield at 26 basis points roughly. So that just means that money that goes into 10-year Treasury is going to earn about 26 basis points more than going into equities. But we've still got such a low interest rate that it's forcing money into the equity markets. And the VIX actually closed down a little over 8% for the week to close out the week at 17.33. So, all in all, it was a fairly good week. I mean, if we look at the economic data that came up this week, the consumer confidence index had its biggest gain in nearly 18 years in March, right? And the regional manufacturing index is also strongly to the upside. The Institute of Supply Management's gauge of factory activity hit its highest level since 1983. So manufacturers are coming back online again. Also, this past Thursday, the Labor Department announced the weekly jobless claims increased 719,000. Okay. And finally, on Friday, the markets were closed, but the futures market was open, and we did see that over 916,000 new jobs were created in March, and unemployment fell to 6%. Meanwhile, auto sales rose 11% overall. So we've seen a very strong start to Q2, right? As earnings are getting ready to tee up in another couple of weeks. I will, for our members, I'll go into more detail on earnings sector by sector of which sectors are looking at doing stronger than others. But the economic data is still very, very strong, right? Now, if we take a look at U.S. Treasuries, obviously with stronger economic data, it's no surprise that the benchmark 10-year Treasury rose on Friday with those job numbers, right? And one other thing I will point out with cheap money, companies are taking advantage of it. We had the highest amount of junk rated debt by companies that, they can't get investment grade bonds. So the highest amount of junk debt was sold in Q1 to the tune of 157 billion. Now, folks, all of this is going to come unwind. It will unwind in a year or two or possibly three. For our members, I keep talking about this. We're going to really have fun when the markets crash, but right now I don't see it. All right, I've been telling our members that the markets, we had a near-term target of 4,000 and we blew through that. We actually hit a high of 40.38 on Friday before pulling back just a little bit. My year-end target is anywhere from 41 to 4,300, but not without some goosebumps along the way. We'll have a scare the children moment. I think we're going to have another one coming up here in the summer months, maybe May, June timeframe, maybe even a little bit earlier. It's going to be a deeper pullback than we got in January in the S&P. I think in January we had about a 6% pullback. NASDAQ, we had about 12%. But we're going to get a little bit more of an aggressive pullback as we go through the summer. I think what's going to be the cause of that is rising interest rates. But we're gonna still have a strong finish to the end of the year because corporate earnings are just coming in so strong. Okay. Now, of course, if we come over to Europe, let's take a look at the European and other indexes around the world. You can see the only one in the red this past week was the FTSE. That's the London market. It was down 5 basis points. But outside of that, everybody was in the green for the week. Year to date, everybody is in the green except for China. It's about break even for the year. All right. They kind of hurt their economy when they came out a couple of weeks ago, about a month ago, actually, and said they were going to start tightening up some of their economic policy. And then they came out about a week ago and said, my bad, we're not going to tighten it up as much as people thought. So the markets are going to, they're kind of self-correcting again. We're going to see that in the U.S. markets when the Feds finally come out and admit that they're going to have to raise rates. And they're going to do it not by raising rates. I think the first action you're going to see by the Feds, they're going to try Operation Twist. Members, I'll go through that again this Sunday evening for our weekly market watch. Then outside of that, they'll probably cut back some of their monthly 120 billion mortgage-backed securities and corporate or treasury market buying that they're doing every month right now. So we're going to see kind of that. But the European shares, as you can see, all pretty much, except for Europe, pretty much all in the green. All right. And they are shutting down a little bit more in some countries over there, but they're up mostly on the U.S., right? Inflation in the 19 countries that do make up the Eurozone did move up in March to 1.3% from 90 basis points in February. So that's a big move, primarily on higher energy. Over there, they use Brent crude instead of West Texas Intermediate crude, which is what we use here in the U.S. And we are seeing other inflationary data coming out across Europe. But the ECB, Christine Queen Bee Lagarde came out and said that inflation, like Boom Boom Powell, that would be Jerome Power Ranger Boom Boom Powell, our illustrious Fed chair, being echoed by the ECB, Queen Bee Lagarde, basically saying it's a temporary spike in inflation, transitory kind of thing. We'll know. We'll see some scares, I think, but I think this year they're probably right. But then we're going to see inflation start to bite the grid, take a bite out of the apple, I guess, so to speak, going into 22 and 23, and we're going to get some ugliness in the markets. But for right now, any dip we want to treat as a buying opportunity. And then meanwhile, in the Asian markets, Chinese equities were up strong over the weekend. As you can see, they were up 1.4%. Hang Seng, which is a Hong Kong index, was up 2.13 for the week. They got a long weekend as well. Okay. Sentiment there also, they're getting, the government came out with additional tax reduction, that they're going to be reducing taxes in some sectors there. So that helped. And we're seeing very strong purchasing managers index data as the US and Europe come back online. Okay. So that's another pretty good thing. We're seeing expansion in the manufacturing data finally in China. So all of these things make for a very positive environment going into corporate earnings here for Q1. So if we get strong earnings, like I believe we will, we're going to continue to run up, at least near term. And then, like I said, in about 6 to 8 weeks, we're going to see another scare the children moment. Once we get through earnings and there's no other news out there and everybody's watching inflation and interest rates, I think that could be the next precipice to cause markets to fall a pretty good little bit in the summer months, but have cash available because it's going to be a buying opportunity as we go into the end of the year. All right. But that's kind of what I'm seeing right now. Let me switch you over to the chart, see if I can't give you a better pictorial of what's going on here. First thing we're going to do is we're going to take a look at the 4-hour charts. As you guys know, I love the 4-hour chart because it's kind of like it's a more detailed, concentrated view of the daily, yet it's close to a daily time frame. Okay. So if we look at the 4-hour chart here, you can see this big blue colored bar here. This was my target, right? And we hit it about a day before. These black lines is the goalpost, kind of defines a time frame, time and price. And you can see that it was right in the middle of the bars, about 4,004, 4,005, and we closed the week. We closed the week out at 40.10. All right, it went all the way up to 40.38 and it pulled back. This will be our support element, 4,000, because what is resistance becomes support, and then underneath that you can see 39.78, which was our previous all-time highs until we just blew right through them. Okay, so and you can see all this volume over price below, so there's a lot of support underneath us. I think as we go out in time, we're going to have a bigger scare this summer. I'm going to show you another chart. Let me just swing over here and show you a weekly chart. Let's get it up on the screen here. It'll take a couple of seconds to paint on your window here. Same chart, but it's weekly. And I've got it all set for you here. You're going to see the S&P 500 E-mini futures when it pops up on your screen here. And you can see, again, 40.38. We're on an Elliott Wave 3 count, moving higher, as you can see. Let me just zip it out just a little bit. And you can see this huge move from the 2020 lows, which were 21.74, which was actually the lows for COVID. And you can see this massive move higher, okay? Now you'll notice I've got a Fibonacci retracements on this and a solid support point on this thing, which is where I think we're probably going to go this summer, is right here at 35.98, all right? That would be a normal pullback to digest a lot of these gains. And that's a pretty good little pullback. If I were to measure it, just to give you guys an idea of what that pullback would look like, let me just put the price ruler on here. Turn it on, and it'll be a close approximation. It won't be exact. But if we come down here like that, you're looking at a correction of about 10.84%, if you can see the screen. So about 10.84%, so that gives us an official correction. Remember, we hadn't had a correction in a while. We barely had it last September when the markets pulled back a little over 10%, okay, in the S&P. And so I believe we're going to get that correction sometime this summer, which takes us 10% off these highs, takes us to the 0.236 fib note. And you can see there's also a key pivot point there, and there's another one down around 35.50. So 3,600 roughly is a solid support point. I can see us coming down and testing that. Not near term, but we are in an Elliott Wave 3. What that would do is it'd give us an Elliott Wave 4 down, and then we would come up and make new highs coming into the end of the year, possibly up to 4,300, all right, 42 to 4,300. That'll be our peak. Then what's going to happen is in 2022 into 2023, we'll probably pull back and chop. The forward returns that we're going to see in the markets are going to be a lot less than what we've seen since 2009. And then we're going to have a bear market, and then we're going to slowly climb out of it. But that's what I would see over the next 5 years, not counting this year. All right. There's going to be some great opportunities for us, but that's for members. I'll guide you through all this. There's going to be some great opportunities. And as you guys know, bear markets, if you understand how to trade them, you can make 2 or 3x what you would make in a bull market. Okay. Once you understand the game. But this is what I'm looking at here. So if we come over and let's look at NASDAQ, let me put it, NASDAQ had a pretty good little move up. Here's the NASDAQ 100 futures. Let's put it on a daily chart. You can see here how we've been hugging the opening price of 2021, and we finally moved back into a solid green. We took out this prior pivot here, and we moved up here. The next overhead resistance is sitting up here like this. And we're on an Elliott Wave 3 on a daily chart. So I suspect we're going to get some nice movement here in this chart. And if we look at the FANG index, which I've got a customized index here of the big stocks, Microsoft, Facebook, Apple, Netflix, Google, Amazon, I think these are much stronger than the NASDAQ 100. Remember, the NASDAQ 100 is 100 of the largest companies in NASDAQ. But these are just concentrated in Microsoft, Facebook, Apple, Netflix, Google, and Amazon. It's a little bit stronger, right? So we're going to come up. And I think if you want to get into some tech investment, Apple, Microsoft's probably the best play right now. But Apple's also very strong. I think by the end of the year, all these stocks are going to be much higher than they are now. Remember, when we do have a pullback, when we do get that greater than 10% pullback, which is what I'm thinking. In the summer, early summer, you're going to want to have some cash on the sidelines because these guys are going to fall pretty hard, and there'll be a great buying opportunity into the end of the year on these guys. Okay. Then, of course, if we look at the Russell had a little bit of a pullback, right? And you can see this upsloping trend line. It hit it perfectly. I think we're going to run right back up. We had that divergence here, which told us to get out of the trade on a daily chart. But you can see right here how it's moving back up, and it's going to come up and make new highs. All right, so it's just kind of where we're headed right now. And then, of course, if we look at the skew, well, first I want to show you volatility. So if we look at volatility, we finally broke the 20 level, right? Look at this right here. We've been holding this level just around 19 or 20, actually the 20 level. And if we just step out a little bit, you can see this level here that we've been holding. It finally broke and it came down. I think you're going to see the VIX slowly slide lower. I think Q1 earnings are going to be very strong, very strong. I think the market's going to run up, maybe even more than 40.50 to 4100. We may get that 4100 near term, and then before we get a pullback. So this is a little bit about what I'm seeing here. Let me put myself on mute for just 1 second. Sorry guys, just had to get a drink of water. So this is what we're looking at, VIX coming down. If we look at the vol skews, if we look at the front month skew, it's into the green, right? Not in the red. That means we're in a normal contango environment. And if we look at the back month skew, solidly in the green, right? So the skews are perfect for us. I think I swallowed the wrong way, guys. And if we look at the bond market, again, any rise in the bond market should be met by selling, right? There is no divergences here. I was hoping the bond market would continue to move higher to the 50 EMA, and then I would be selling. But right here, it's just, I wouldn't chase it. This dead money right now. The bond market. Remember, when this goes down, interest rates goes higher. And if we look at the 10-year rate, damn, you can see left to right on the screen, it's doing nothing but going higher. And we're going to continue that run. But I do believe near term, when we do get that bigger pullback sometime in early summer, you're going to see the rates fall. And it'll be a time to go load up on longs again for rates and shorts on the bond market, right? It's going to be a great play. Of course, if we look at the dollar is stronger, right? Surprising everybody. Everybody was short the dollar on the left-hand side of the screen. In fact, we were over here. As soon as it broke this level right here, I was telling our members to go short the dollar. We had folks that were playing it via long euro because I was calling it low-hanging fruit trade. And I said anytime the dollar index comes up at or slightly over the 50 EMA, just like the bonds, sell them. And now everybody most people got short the dollar over here in November of last year, but the actual trade in the dollar was back in May of last year. That was an easier type trade. And then as people start to load up on the shorts down here, obviously it goes the other way. And you can see here that we're 2021, we made a high, 2021 high on end of March, right? March 31st, we actually made a new high for 2021 in the US dollar. I think it can go higher, guys. And eventually, though, the euro is going to come undone, right? Or start moving higher. You can see the euro broke the 200 EMA coming down here. Over in this area over here, it was a low-hanging fruit trade. I do believe the euro is going to come back up, though, and move back up to 1.26. We don't have the trigger yet. You can see there is no divergences on the MACD. That suggests the dollar will go higher and the euro will go lower. Members, I'll give you guys better clues on some of this stuff, but we've got a number of members that play the commodity and currency markets, and these are just, I call them low-hanging fruit trades because they tend to hold up for a longer period of time. They tend to trend for a long period. And take a look at the Japanese yen, guys. I mean, is that an undone or an undone, right? Let's just put it here on the 240-minute chart. You can see on this 240-minute chart, every time it breaks your regression channel, it does a retest. It tried here, and then when it took out that pivot low, it was all over with, right? Actually, it was all over with, to be honest, when it took out this pivot low right here back in early February, right? And then away we go right here. I would not chase it down here. I just would not do it. I think it'll run up, but if it runs up, I would sell it, sell the yen back into it. Okay. And then of course, if we come down and we take a look at gold, as you guys know, I think I even told you guys too, down this level down here, I'd play gold to the upside. It's a good day trade move up. Okay. For our members, I got a couple of ways to play gold and a good minor that I think makes sense on this. And then I think it's going to run up here and then probably challenge this. The first challenge is going to be the 200 EMA. Okay. And then we're going to roll. All right. If we look at copper, I am still bullish copper. You can see that long play there. And you can see it's finding support around the 200. Or let me just put it on the day chart. You can see it better on the 240, but let me just put it on the daily so that you can see right here. You can see we got long copper back over here. I came out with a list of about 10 companies to play long and commodity, or 10 assets to play. That'd be a better way to say it, from currencies to commodities to equity. And this has just been a great run for us. I think it's not done yet. I think it's going to go much higher. Okay. So we're just playing that run in the commodity market. So in the metals market, commodity is better than gold. But if you're going to play it, I wouldn't play gold. All right. I'd play silver. If we take a look at silver, you can see here that it's holding the 200 EMA. I have said gold is dead money near term, right? But if you do play it, then I would be into silver. I think longer term, silver is going to go higher. It's going to go back up and challenge this 30, 35 area and go higher. That was when there was a short squeeze on, and I think the Reddit players came in there and tried to run silver up, but it didn't last very long, and then it sold right back off again. But we're at this level here where I think longer term is going to be building support. Of course, if we look at oil, OPEC came out, increased their production levels right in this level here. I think I even told you guys, in addition to our members in our site, our user group, fade that move. And then I think right here, we're going to stay in a sideways pattern for a little bit. I don't think it's going to take that number out, and I don't think it's going to go below 55. So you've got a wider range, but in the oil futures markets, you can play it with flies. I like using calls in this particular case and do them as a broken wing or an unbalanced so that you can, the risk of a bigger move right now is probably going to be an upside risk. Now, when we do have that crash, or it's not a crash, let's say a correction in early summer, at least that's what I'm seeing, all the cyclical companies, especially oil, you're going to see come down and then use it as a buy-in opportunity. That's the way I'd play it. Okay. Same thing with gasoline. If you look at gas, again, a move faded, but getting long gas over here was the play, right? It's a little bit late in the game right here, but that was the play. And then same thing with nat gas. Nat gas, anytime it moves up like this, you want to be selling that sucker, not buying it. A lot of dumb money chases nat gas up here, and they're getting long up here, and you do not want to do that, right? As long as it's over 3, you want to be selling nat gas, not buying it. All right, that's a little bit about how I would see it. Now, there's other plays out there, some other good infrastructure stocks, and with this new infrastructure bill that the White House came out with this huge spin. Members, I'll go through some of these interesting plays for you guys in our weekly market watch this Sunday evening. If you're not a member of our group, I highly encourage you to come in and check us out. Members, I'll see you this Sunday night. Otherwise, enjoy a nice holiday weekend for most folks. Take care, everybody. Ciao now.